Tesla's soaring share price is defying the bears and leaving short sellers burned. The electric car maker's market value soared to just under $99 billion last week, up from a low point of $32 billion in the middle of last year, when the company was plagued by operational worries and financial instability. The valuation is nearly double that of General Motors, a company with a net income of $8 billion last year and almost 20 times the number of vehicle sales. Amid the apparent operational chaos at Tesla, analysts' share price forecasts had indeed been much lower. The big losers here are the short sellers, who, according to research group S3 Partners, have suffered losses in the region of $3.27 billion since the start of the year. After reaching a peak last summer, shorts against the company have steadily declined from 43.7 million in the middle of last year, amounting to around 24% of the outstanding stock, to 26.3 million at the end of 2019, the lowest level in a decade. Tesla CEO Elon Musk certainly won't be shedding any tears, having previously described them as saboteurs who want the company to die. Confidence in the carmaker began to grow after the release of surprisingly strong quarterly earnings 3 months ago. Earlier this month, it had been the strong vehicle delivery numbers that have boosted the share price, adding onto it another $100. Tesla have also begun to deliver vehicles to their customers in China from the company's new production plant in Shanghai. Whilst China's electric car market is faltering, not helped by an economic downturn as well as the loss of buyer incentives, the speed at which Tesla has launched production in the country has been impressive, particularly after the issues that they experienced in the US with the launch of the Model 3 in 2017. Along then with the increased confidence in its production capability, the market also appears to be more confident in Tesla's financial stability. Less than a year ago, the company was plagued by bankruptcy rumours, adding to the volatility of the share price, with Elon Musk informing the market that he would not be looking to raise additional funds even as they dwindled. In the end, he relented, raising more than $2 billion last May. It certainly looks to have been a wise move, with the funds put to good use. Since then, Tesla have delivered 2 quarters of positive operating cash flow, amounting to $1.6 billion, with market expectations for this year of profits in the region of $1 billion, a significant improvement on the losses of nearly $5 billion over the last 5 years. The biggest problem on the horizon looks to be an increase in competition as the larger and more established car makers start to make bigger inroads with their own electric vehicles. In this case, Tesla will be keen to keep itself seen as a tech company rather than just a car company. The planned robo-taxi service is one way to do that, with Elon Musk claiming that Tesla owners might soon be able to make some extra money by renting out their cars as driverless taxis.